everybody, this is Phil Town.
And this is Danielle Town.
Welcome to the InvestED podcast. We're deconstructing long-term value investing as kind of created by Warren Buffett, Ben Graham, Charlie Munger, and which I've been practicing for many years, decades, because I'm old with gray hair, as you can see if you're looking at the video. And my daughter, the merger acquisitions attorney, who is practicing this style of investing now for 8 years, having started.
As we said, I don't count the years of illness. So
okay, fair enough.
Yeah. Let's go with like 4.
Okay, 4 years. So that's what we do here, and I hope you guys are enjoying it. We're going to dive into what today? What are we diving in? Danielle's in Zurich. It's a little later there.
I felt dissatisfied by the end of our talk about Ulta because it was very much like it's maybe not great, the end. But that's not enough, right?
No, that's enough.
So that, I guess that's what I'm wondering is like, is that enough?
Yeah. Oh yeah. Maybe not great is plenty. Because we just buy great. So maybe not great falls into the category of a no, or it's too hard, or I don't know is a too hard, or a maybe is a too hard, right? I mean, those are all just too hard. Now, Ulta, I think is worthy of, well, I guess the last category is it's worthy of further digging. Is that kind of what you're thinking?
Right. Yeah.
So not too hard, but worthy of further digging.
Right. So like on our weather matrix, I've got lots of time, but maybe worth studying. And that's what it kind of sounded like to me from the way you were thinking about it, that you were curious about this CEO. You kind of were disappointed in the way he's been handling things. You're maybe thinking that the industry is changing or downturning or has already. And what? Like, do you step away at that point?
Well, I think this is where having a lot of passion for the business, having a real sense of connection to it is super, super helpful, as opposed to just coming in at like I am, being drug over to Ulta when I was on, Dilaudid, right, and getting my hair dyed black. It's just like... Whatever else could say that you don't have a real feel for this, that would be a good anecdote for it. I don't have a feel for this. And so I don't really have a sense of what people who use makeup, which are predominantly women, will do in a recession. But my business sense is that that you've made a case that the prices and the quality of makeup has been vastly inflated, that people are...
Prices inflated, quality improved.
Right. Okay. Either way. So you end up with a not depression scenario where people are needing to buy a $95 lipstick from Tom Ford over at, is it Sephora that sells that? Someplace you
Sephora
got a $95.
Does sell Tom Ford. That's true. Yes, that's right.
So you that isn't a tiny luxury, as in the Depression era use of lipstick, when people are putting flour on their face for mascara. So a tiny luxury could also exist at $20, not $95. So the real question is, and I don't have a feel for that. I really don't. I don't have a sense of whether women would be driven to buy a $95 lipstick in a depression. I really don't know. But my gut is that doesn't make sense.
But isn't it much more sophisticated than that? I mean, it's not whether or not women are going to buy lipstick. It's whether or not the cosmetics industry will either maintain or grow through a recession.
Why isn't it, will they buy $95 lipstick? Why isn't that a simple statement about what the question is? Because here's the thing. If they won't buy $95 lipstick, then the inflation in pricing has to come down, which means revenues will come down – because they're going to only buy so much lipstick. right? There's a certain amount of lipstick.
Yeah.
So if you're going to buy a tube of lipstick and you pay $50 instead of $95, you've still got a tiny luxury, but the revenues of the industry are coming down like a brick.
Yeah, that's what I'm saying is like, it's more than just like, will you buy lipstick? It's like the level was, 3 lipsticks, 3 blushes, whatever, 2 mascaras, like that's what you buy a year. And then that level changes, that level drops. So now it's 1 lipstick and 1 mascara for everybody.
So I would say that it's an inflation argument that prices and amount of use and all of that is being driven by a lot of money floating around.
Mm-hmm.
And it's not going to be driven by that money if that money goes away.
Exactly. Yeah, exactly.
And therefore revenues drop like a brick. Therefore the price of the stocks will go down like a brick. And we see that responsiveness in the market to Ulta on a quarterly basis almost. Like they'll come in with a good quarter and prices will go up 10% that day. Come in with a bad quarter or announcing the CEO's leaving, the price goes down 30%. Boom.
So you're seeing big volatility in that
huge
stock.
Volatility in Ulta.
Interesting. Which tell me if you agree with this, that investors are not sure of that company's future.
Exactly.
If they're responding so quickly to short-term info.
Well, it's a kind of a classic shift that we've never talked about. Is a company going from, because we don't think in terms of growth and value, which are 2 massive categories that Wall Street thinks of religiously.
I can't stand those categories.
Important qualities.
We've talked about that before. It drives me nuts.
So Ulta has, all through Mary Dillon's stewardship, has been a growth stock, growing in the high teens to low 20s per year, massively up there with other great growth stocks, right? So the impact of that on Wall Street is a certain expectation that will continue as it has in the past. It's going to continue. So we're going to give it a more and more inflated earnings ratio, PE ratio. We're going to pay more for that stock because we can afford to, because it's got so much growth.
Right. There's a big future of growth.
Big future of growth.
Yeah.
Well, the CEO just chopped the future of growth down to more inflation plus a little. He's talking 7%. You got 3.5%, 4% inflation. So it's, they're going to grow at 3% in real terms. That is not a growth stock. That is what they would call a value stock. If in fact it's very consistent in producing that 3% of real growth, then yeah, that's a nice value stock. But people won't pay for that. Mm-hmm. The PE ratio will shrink dramatically. And when that PE ratio shrinks dramatically, then the price comes down like a brick. Just think about the math on it, right?
Yeah.
So, yeah, that's what happens, as you're right, saying that people are very concerned. They're not certain that growth is going to continue. Then that gets very volatile. So if the guy comes in and says, 7% next year, and they come in next quarter with a 15% quarter, then Wall Street will go, oh man, he was sandbagging us and we need to be in this thing. And they'll all jump back in. It goes up 10% again. So this is the short-term view of Wall Street against sort of our view of the world, which is very long-term. We're not value, we're not growth. We don't care about either of those categories. What we're looking for is to figure out what is the value of the business. Not that it's a value stock. We don't care about the stock side of things. It's a value business. What is the value of this business, and can I buy it at a great discount? That's what we're looking at. And I would go even further, Danielle. I would say not only that, but we are really looking for that rare franchise that can in fact grow at a high rate. We would love to have that in our portfolio. So a company...
What does that mean to you that's different than a growth stock, quote unquote?
Well, we don't think in terms of growth or value. We think in terms of certainty and of the future. So growth stocks typically have a fairly low degree of certainty. Nobody really knows for sure they continue growing at this rate. So we'd want to look at this and say, no, we know quite comfortably that this company can grow very consistently into the future at this rate. And that rate's a high rate, 12%, 14%, 15%.
I mean,
it
yeah.
can do that.
And exactly what you're saying is I think what a lot of people mean by growth stock, they mean a company that they feel confident is going to grow at a high rate into the future. And yet the way that it's used is more in the speculative sense. But I've often, when that has come up with people who aren't into the Buffett style of investing and they've mentioned growth, I've said, basically what you're describing is a Buffett is a long-term value investing stock. It's a stock that's expected to do very well over the next number of years. You want to hold on to it because it's going to grow so much, and it's a great company. And they're like, yeah, that's a growth stock. All right, whatever. Right. Whereas a value stock is considered this boring, relatively low priced stock compared to the company. And like you said, it's just sort of going to be reliable, which is also fine. I guess you can call that value and growth, whatever, but it just seems to me to be a useless distinction.
I think it is a useless distinction. And I think that ultimately, and having said that, I will say we would love to have companies that can grow very consistently in our portfolio. And let me show you the difference between one that grows really consistently at 3% versus one that grows really consistently at 15%. Okay?
Sure.
Okay, so we buy both of these at half off.
Okay.
Both of them are a super deal. All right? And typically, in under 3 years, the market recognizes its error of its ways and reprices those companies at their value.
Mm-hmm.
And what that means is, since we bought it for half off, we have received a 100% return.
Okay.
Because it's gone back to its value, which is double what we paid for it.
Mm-hmm.
Okay. So now it's at its value. Now it's going to appreciate in value relative to the production of cash flow into the future. With me so far?
Yes.
Okay. But this one is growing at 3%. Its cash flow is growing at 3%. Therefore, its price should, in a very rational world, grow at 3%.
Uh-huh.
This one's growing at 15%. Therefore, its price should grow at 15%.
Mm-hmm.
So this one is way better if we can find it than the 3%er. The 15%er is way better because we can leave our money in there. We're comfortable with a 15% growth rate forever. We would love to have that. It's like we bought the thing super cheap, it doubled our money, and now it's continuing to grow our money internally at 15% per year.
Is this a
awesome
debate with anybody? Yes, that's great.
Well, okay, maybe you don't see
I'm lost.
the distinction. So which one would you rather
What's the
own?
problem?
Which one would you rather own?
Oh, let me think about it.
Okay, the 15%er. Or are you going to buy the 3%er at all?
If I can't find a 15%er and I have a good, reliable 3%er, yeah, I'd buy the 3%er.
Right. So we don't have to distinguish between a value stock and a growth stock when it comes to what we buy. But we do have to distinguish it when it comes to what we hold. Now, does that make sense?
Sure.
We want that company to compound our money at a high rate of return. They're very rare. And even rarer is when they go on sale.
And even rarer is when you hit it and predict it right, and it ends up happening.
Right?
I mean, this is the mistake that you talk about is sometimes a mistake, sometimes not, is selling too soon. And the reason that you do that is not to make a mistake. It's to avoid putting money in something that's not going to be the 15% compounder.
Exactly.
And
actually, I did it because
that's a choice, right?
I get a little
guess.
greedy. I'm always thinking in terms of 26% per year compounded is my target.
Mm-hmm.
And so think about what that does. And I've started to realize the error of my ways here after only 40 years of this is that if I end up with a company that could grow really steadily at 15% per year, and I've already doubled my money in it, because I started with nothing, my long-term view of this, or sort of my anchored habitual view of this from experience is, time to sell and move that money someplace where I can get 26% a year, because I can no longer get 26% a year from this thing.
Essentially, you want to do it again.
Yeah, I want to do that again.
Yeah.
But what I'm finding longer term is the same thing that Buffett learned over the years, is that it's just better to sit in it. And part of that comes from the market's almost unfailing misvaluation of that stock on its way up. So if you've got something that grows at 15%, and I value that with, let's say, a 30 PE, I'm looking at it as a 10 cap. I'm putting a value on it based on rationally thinking about what I'm going to get out of it. The market doesn't necessarily do that. It isn't necessarily rational. And what we see is it can take companies massively, not a 30 PE, it might put a 60 PE on it because it's so consistently growing. And that I've missed out on over and over and over again by being a bit overly confident that the market will price this thing rationally. It apparently won't.
I don't know. I don't think it's irrational. I don't think it's irrational. I think it's actually, I think it's a really good point, and it's something that I've learned, sort of, but it's good that we're like saying it out loud, that those kinds of companies that are great companies and have been growing at a high rate and probably will continue doing so, but that now the price of the stock is at a relatively quite high PE ratio. There are not a lot of those, and even in like the crazy markets that we've been in. And I think what's happening is that people want to own that company. Like that's a great company. I want to own it. I'm going to pay the premium. Mm-hmm. And that then makes the price go up more. And then, maybe it goes up to 60 or 100 PE, like where somebody looking at it from the numbers point of view would say like, there's no way you can justify that. But from a marketplace point of view, it makes total sense, actually.
And we've seen this mistake, if you want to call it that, or this, I don't know, this need to follow the crowd into something that's really doing well, create some really crazy numbers. Like Yahoo, I think, famously hit an 11,000 PE ratio back in 1999.
Is that true?
Yeah. I mean, it turned out to justify the price people were paying for Yahoo right before the market crashed in 1999. The price they were paying would have required that Yahoo become the entire GDP of America. Mm. It would have to be the only thing people bought. They didn't buy food. They didn't buy armaments. They didn't buy anything except Yahoo advertising. That was it. So that's impossible. And yet people didn't care. They just knew it was going up, so they just kept buying it.
Yeah.
And so, we see that happening all the time, and you kind of want to go for that ride. Especially if it's a good company. Yahoo turned out to be not so good. But if it's a really good company, you want to go along for the ride as far as you can ride it. That becomes difficult for me, because I'm much more in the sort of early Buffett tradition of take it to its intrinsic value and sell it.
Yeah, that's definitely what you taught me, and we had many conversations about that.
Yep. And that starts to look a little shaky in a market like this one, which is, it's just, this market has got, it's snorting cocaine from the Federal Reserve. I mean, it's running on empty, and it's running on literally $8 trillion new dollars that got put into it in the
Sorry,
last couple
I
of
just
years.
need to like have a book that's entitled Snorting Cocaine at the Federal Reserve, because that's unbelievable and I need to read it immediately.
That's a good book. Oh my God, that's a really good book title. All right. You guys didn't know they were that loose out there. So, but that is, I mean, they have printed, it's not just the Federal Reserve. The Federal Reserve is monetary policy. The federal government is fiscal policy. And the federal government has been dramatically irresponsible since COVID hit. That I can't say they were irresponsible initially, because clearly we needed to plug a big financial hole when everything shut down. But following that, we've been running $2 trillion a year in deficits. And that is adding to the inflation fire and the fuel that sends the stock market to these crazy prices, at least historically speaking. The stock market is priced at double on several metrics what it's been priced at historically for the last 140 years. And you could try to make an argument that the world is different now, but that argument has failed repeatedly over time, and I don't buy it.
What I think is so interesting is this concept that a company that's a great company, let's say according to us, it's just full on like rule one, Buffett, great company.
Yeah.
Might actually now, because I don't think this market, yes, there's all those other components that you just mentioned, like the fiscal policy and recession or inflation and and things happening macroeconomically. But the fact that the stock market is available now to so many people, frankly, like me, who are like at home and doing whatever, isn't going to change. And it's probably only going to become more accessible. And I hadn't quite put this together, that with a great company, maybe there's now so many people that are really wanting to be invested in great companies that those can maybe be expected to really exceed the normal growth pattern, the normal trajectory, let's say, if there is
of
one.
Of their stock.
Yeah.
Right.
Yeah,
I'll buy that.
I think that's actually a decent hypothesis.
Well, I'll add to that some more fuel.
Sure.
And that is the ETFs. So as a company goes up, if it's a great company, chances are it's in an index. And as it goes up, the indexes all have to buy it. Mm-hmm. I mean, the index funds, the exchange traded funds. As it goes up and the index, the exchange traded funds have to come in and buy it. And the exchange traded funds are now 30% roughly of the market. I mean, they have unbelievable buying power with trillions of dollars of the market. 30% of the market is what is it, 10 trillion or something like that, ballpark. And so these managers of ETFs are required, it's automatic, it's computer driven to buy that stock more if it goes up. Mm-hmm. So that combination of people buying it because they see it going up and want to be part of that because it's a great company and you're looking for something to invest in, mm-hmm. plus the ETFs having to buy it, whether it's great or not, they don't care.
And they're doing that because of rebalancing their portfolio.
Rebalancing to match the index.
Yeah.
Those two things could drive this thing remarkably high. And I mean, it might be somebody's thesis that says that things are different now than they've ever been. And therefore the market is priced differently than it's ever been. And hang on one second. I somehow managed to get rid of my screen. I totally did. I touched a button. I don't know what I touched. There you go. You're back.
You got it? Okay.
Yeah. So this is sort of countering my own view that, the markets never change for 140 years. They're always the same. They go through this boom bust cycle. Mm-hmm. But I can see the argument that it's been 20 years now of this boom cycle with one exception, a crisis driven by by subprime mortgages and a crisis from COVID. Other than that, this is 20 years straight up, driven, one could argue, entirely by cheap money and qualitative printing of money, so that since 2020, the United States dollar has gone from roughly $2 or $3 trillion in circulation to $22 trillion in circulation. Mm-hmm. So we've managed to produce about 90% of all the dollars in circulation in the last 20 years. And that is juicing this thing. And that's what makes me say this can't last. This printing of currency to pay bills can only go on for so long. And we're very rich, so it's gone on for a very long time. But when it stops going on, everything resets.
Yeah, sure. And then when it resets, are the same patterns going to carry out? Because that's what interests me as an individual investor investing in individual companies. I'm not like, I don't know anything about macro, and I'm not trying to. So we have a giant reset. Prices all drop. I'll say your favorite, Chipotle Mexican Grill, is there for the taking at $50 a share.
Yes.
It's still a great company.
Yes.
People still want burritos, right?
Yes, more than ever, because they're in a recession.
And so maybe in a situation, I guess this is my new hypothesis. Maybe the situation is such that it's going to happen again, where because it's a great company, it just gets better. The price of the stock gets bigger and bigger and bigger and bigger, more so than would be considered supportable.
So next time,
and so maybe as individual investors, that's something to stick with.
Yeah, I mean, I think the governments are going to make the same mistakes they always make, which is these modern governments are no longer anchored by any relationship to anything that limits printing. Like it used to be anchored in gold and silver. But as in every empire in the history of the world, they always start devaluing their currency, and they have to because they want to stay elected or they want to stay in power. So I think those dynamics don't change. So if we get to buy Chipotle at 50 someday in the future, it's going to go back to 3,000.
Yeah, exactly.
Because they're going to print enough money they're going to just they'll print the money.
Well, let's say regardless of the printing of the money.
Oh, well, that's what drives it up there.
It's the people buying and selling and having the money to buy. The money,
which comes from printing the money.
Okay. Yeah, it's maybe that part of the whole it's a different world kind of thesis might be right. I think that might be right.
Yeah, it might be right.
And
but it's not
that directly goes
reset.
to don't sell, basically. That's what I'm getting at. Don't sell.
Oh, yeah. If I own Chipotle at 3,000, like I sold out already, okay? But if I own Chipotle at 3,000 and I'm seeing this sort of end of game coming, the market is starting to drop. Chipotle goes to 2,500. We're heading for a recession. I probably would sell.
Yeah, but I played that game.
Warren Buffett.
I played that game and I lost.
I know. I hate to say it. I mean, here's the thing, you guys.
I can't predict the future. That's what I've learned.
And here's the thing. If you sell, you stand the chance of reducing your overall rate of return because that thing turns around and goes from 2,500 to 5,000. And you're not along for the ride. And I've done that over and over again. But this can also make you very rich, having cash available when the market crumbles. So if it doesn't turn around and run back up to 5,000 or run to 5,000, Chipotle drops on down to 200, you will have wished you sold because you've just missed out on a future fortune. So here's how I would think about it. If you're protecting a portfolio, you've already got a lot of money, hang on there. You're Warren Buffett with your millions or billions. Hang on to great companies. They're great franchises. Don't stress yourself and just ride them up and down over the years and you'll be fine.
I mean, honestly, I think that's the lesson that I've learned. This whole sort of trying to time it thing is
But Buffett
not,
does
it
that.
doesn't work.
Buffett's timed it over and over and over again by this simple formula, not looking at what the market's trying to do one way or the other, but what individual companies are priced at relative to their value.
What has he, genuinely, what has he sold and then repurchased and then sold and then repurchased multiple times?
Well, you just shifted the argument to Buffett repurchasing something. So let's stay
I thought
with,
that's what you were saying.
He just sold and then came back into the market later and bought other stuff. So
okay.
1987.
I thought you were saying he goes in and out of companies to try to basically like buy and sell high and low.
I know he said he wishes he could.
Yeah, I know.
but I know that like in 1987, for example, he got out in March almost entirely into cash. And then the market crashed like crazy and he bought a huge pile of stuff. And it was vastly great that he did it like that. Mm-hmm. He's been enormously in cash lately. I mean, he's over 155 billion in cash right now. Mm-hmm. So he's not buying stuff. Now, the difference between Buffett selling things to get to cash, which is what typically we would have to do, and simply having the cash hoard grow from the existing investments, it's a pretty different situation.
Yeah.
The analogous situation I wrote about in Payback Time is that you have a job and you're earning money and you're feeding into your equivalent of Berkshire Hathaway, right? You're feeding into the Berkey. All of this money coming off of your job. That's the equivalent of Buffett's pile of companies that are feeding cash to him. Mm-hmm. And so if you'll do that, you will have cash available, even if you're doing what Danielle may be doing, which is holding. You'll still have cash available because you're saving money as much as you possibly can because you know this day is coming when you can buy stuff super cheap and you want to have a big bucket to buy with at that point. Yeah?
Yeah.
Well, let's wrap up on that piece of genius.
Oh, yeah. Let's wrap up on that piece of genius. I still feel dissatisfied with Ulta, so maybe we'll come back to it yet
Lord.
again.
I hope not.
Oh, really? You're tired of it? You're done? It's too hard?
I don't know where to go from here. I'm not sure what the answer is with Ulta, really, frankly.
Then I think that's the answer then. I think
it's actually a very, very good company that I just don't know how much bigger it's going to be in 10 years.
I think that's why I feel so frustrated. Yeah.
I think it'll be bigger, which puts it into the 10 cap category of valuation. If you're not sure what that is, you guys just go read InvestED, where Danielle explains it, or I explain it very brilliantly, and Danielle re-explains it brilliantly, on what a 10 cap valuation analysis is that doesn't depend on growth rates. It just depends on approximation that it's going to be bigger. And then it's going to give you a price. And I promise you that price isn't going to be remotely close to the 400 and whatever it is selling for today. Mm-hmm. Not going to be close. It's going to be half of that or worse. So,
but that was a genius point. Use the 10 cap because it doesn't require a growth prediction.
That's right.
I'll give you that genius point, and I think we should end on that one.
Thank you so much. You are so sweet. I love you, honey. And,
all right. Love you
too.
too.
Next chat.
Thanks, everybody.
Time to go play. See ya.
Bye.
Hi guys, thanks for listening to InvestED. If you enjoyed this episode and you want more information or to listen to additional episodes, visit our website at investedpodcast.com and sign up for my virtual workshop right there. Spots are definitely limited for this event. I'm not kidding, they really are. They sell out very quickly. So everything discussed on this podcast, by the way, is either my opinion or it's Danielle's opinion. And really important, it's not to be taken as investing advice because I am not your financial advisor, nor have I considered your personal situation as your fiduciary. So remember that. You're on your own here. This podcast is for your entertainment and education only, and I really hope you enjoyed it.